I am here at Camp Kotok with Jim Bianco Research, and Samuel Rines of Corbu. Gentlemen, great to have you here. Skip's talking about fishing. It's been great. We know that. Jim, I know, what is the current state of inflation right now?
The inflation rate peaked a year ago at 9% on a year-over-year basis, measuring by CPI. It has fallen now to 3% by June of this year, year-over-year CPI. There seems to be a big base effect in inflation, meaning that a year ago's monthly inflation number for July, which we will get in a week or two, was 0 because of a big fall in gasoline. The estimates are that this year's July number will be 0.4. So you'll drop a 0, add a 0.4. Your year-over-year from 3.4 will jump to 3.4 from 3%. And then in August, we've had a big spurt of gasoline prices. Last year was 0.2. We could jump over that. And the year-over-year number can go up again. I think that matters for the Federal Reserve that wants to bring inflation down. That will matter for the narrative about inflation. But Sam, you've been looking at what corporations have been doing with inflation. What are you seeing right now? And what is it that you look at?
And this is the incredible point that you're really not seeing this fundamental disinflation outside of goods, outside of commodities, that's really going to push through to any of the overlying numbers. What I've been looking at is what corporations are doing with pricing, particularly on the front of those consumer-facing companies, the Procter & Gamble's, Coca-Cola's, Pepsi's, whoever it might be, McDonald's. When you look at what they're doing with pricing, their pricing is still increasing in the high single digits, low double digits. It's an incredible amount of pricing that's coming through the system. And what you're beginning to see is pricing kind of peak, but maybe not quite peaking. And you're beginning to see the disinflation on the commodity front really show up on the margins. And so companies are all of a sudden capturing back the margin that they lost during COVID, and they're really happy about it. And so there's a whole bunch. It's kind of fun because there's this excitement from corporate America that they're getting that margin back and they don't have to give back the pricing. And that is a tremendous amount of margin as we move forward.
I was going to say just how far we come. I'm old enough to remember March of last year. And in March of last year, Procter & Gamble made an announcement in their quarterly earnings report that they were going to raise prices in September. And they were, between March and September, put out a white paper to explain why they were raising prices. Now they just raised prices and told you they did it a month ago, because that's how far we've come with the acceptance of raising prices. Yeah. They had to explain themselves a year and a half ago. Now you just raise them.
And you just raise prices, and you have the consumer going, okay. And it's that, okay, that really matters when we think about the inflation dynamic moving forward, that companies are very comfortable with trying to find the elasticity of consumption that makes the most sense for them. And when you have the ability to raise price and you don't have to create any sort of capacity for volume, that is a really, really good thing for your bottom line over time, because price is pure margin as long as you eventually get back to your old cost structure. If you want to increase volume, that's an extra factory, that's extra employees, that's a different ballgame. And if we're looking at inflation in terms of the back half of this year and into next year, it is really difficult to come up with a situation where you're getting any of the disinflation of commodities passed on to consumers. And I think that's, to your point earlier, I think that's going to be a pretty big problem.
The interview you're watching right now was filmed at the legendary Camp Kotok, an invitation-only retreat with prominent investors, economists, and wealth managers. Fishing, wine, and conversation are the hallmarks of this annual event held at Leen's Lodge in Grand Lake Stream, Maine, one of the state's most remote venues. I was very lucky to go to week 1 of this year's Camp Kotok, and I'm very grateful to David Kotok for inviting me and to Daniel DiMartino Booth for helping me greatly in being granted access to this exclusive event. Camp Kotok attendees are bound by Chatham House rules, where participants are free to use the information received, but neither the identity nor the affiliation of the speaker, nor that of any other participant may be revealed. Accordingly, most of the information I heard will stay concealed. However, I did manage to get a few participants on the record, so Forward Guidance viewers will be able to hear my interviews with, among others, David Kotok, Daniel DiMartino Booth, Jim Bianco, Sam Rines, Leland Miller, as well as Dennis Lockhart, who from 2007 to 2017 served as the president and CEO of the Federal Reserve Bank of Atlanta. A big thank you to the Global Interdependence Center and Cumberland Advisors for making this event possible, as well as to Leen's Lodge for sharing their beautiful acreage and making us feel right at home. Now, back to the interview.
What about services?
Services, again, you want ketchup on your French fries at a restaurant, guess what? You're paying a little extra for it. And when you have employees that are very difficult to come by and very expensive,
right,
you're going to have a much different story when it comes to the stickiness of services inflation over the next, I would say, over the next 3 to 5 years, not 3 to 5 months.
Sweet Greens, which the famous for the $14 salad, is now charging you extra for bread and extra dressing right now. They made that announcement last week as well. But I would argue that what we've been saying is there's a stickiness to inflation. And I want to use that word carefully. No, we're not going back to 9. We may not even go back to 6. But if we're going to stay with a 3 handle on inflation, maybe a low 4 handle on inflation, I don't see where the Fed could say, well, we've done enough. We'll just kind of sit there and we'll wait. There could be 1 or 2 more rate hikes. And the big open question is, if the Fed is not done, how do financial markets respond to the Fed potentially not being done? I think that they will, especially the non-Magnificent Seven, the non-mega tech companies, will struggle a little bit with that idea that the competition of interest rates will continue to be a problem. What's your take on it?
I would say it's been a struggle for the majority of the year, right? But I'm not sure 100 basis points is really going to matter in terms of that dynamic, because at the end of the day, you're looking at the difference between, do I want an extra 100 basis points, or do I want the potential of another 300 or 400? Mm-hmm. Right. So there's always going to be that dynamic. I do think that the Fed going another 2, 3, 4 times is going to have an effect overall on risk assets. And I would say it starts with the dollar and ends with the bond market, as it always does, right? Currencies are going to be the number one place to look, and bonds are going to be the last, right? Because bonds are the ones that destroy, and the currencies are the ones that lead. So I would be pretty tentative on adding a significant amount of risk into the back half of the year, but I wouldn't be timid about holding my current allocation.
As far as the bond market goes, we're recording in the first week of August, and we saw the long end of the yield curve start to move higher. In October of 2022, that was the peak for the cycle in interest rates when the 10-year, hit 4.24. We hit 4.21 on Thursday. So we're and then we backed off a little bit on Friday with the payroll report, but we're close. We're close to those highs. I ultimately think that we're going to see long-term interest rates go through those peaks, that the peak of the cycle for long-term interest rates is ahead of us. It's not necessarily behind us. Is it all the way to 5% or 6%? So?
Oh, no, for the 10-year.
For the 10-year. For the 10-year, is it all the way out to 5%? I'd say yes, but I would feel more comfortable with the idea that the trend is up and the peak is ahead of us. Is the Fed looking at potentially 6% on interest rates? Well, they're 5.25% to 5.5%. Now that's 2 rate hikes. Sure, I could see that definitely being at least 5.75 to 6%. What's your take?
5% on the 10-year sounds perfectly reasonable if the Fed doesn't hike from here, right? So I think there's a little bit of a dynamic there where if you don't get a hike from the Fed, if you get a pass, if you get a little bit of dovishness, all of a sudden that long end is going to get a little frisky in terms of yield.
Why? So
why? Because you're going to have a little bit more of a longer term inflationary aspect. priced in, you're going to have the potential of the Fed being fine with a 3.5%, 4% type inflation number, right? Pseudo declaring victory, right? Not saying it out loud, but saying it in policy terms. So if you get some sort of dovishness out of the Fed, 5.5%, 6%, 10-30s sounds perfectly reasonable to me. If you continue to have the Fed raising on the long end or on the short end, what I would say about the long end is you're going to have a tremendous amount of pressure, because there's no sense in allocating to duration when you have, there's no sense in buying the 10 to 30 year at 3.5 to 4-5% when you can buy the short end at 5.5 to 6.
I'll credit Bill Gross. He tweeted this out this week. I completely agreed with it. If inflation, the long run inflation rate for now looks like it's 3, let's use that number. Well, the Fed has already said, John Williams, the New York Fed, has already said that neutral funds rate is 50 basis points over the long run inflation rate. That's 3.5. The normalized yield curve, we're an inverted yield curve. We know inverted yield curves are not the normal state, but the normal yield curve should be the 10-year being about 150 basis points above the funds rate, otherwise known as the term premium. Okay, 3.5 on the funds rate, 150. That's 5. That's fair value for the 10-year note is 5%. If we have a 3% long run inflation rate, we're at 4 right now on the 10-year. So now that doesn't mean we have to go there right away. I think over time that's where we'd settle out. If you believe in the price over volume, in that companies are raising prices, it's a little bit sticky, that we're closer to 3 than 2. I know that some equity people might look at that and say, what's the difference between 3 or 2? There you go. It's 4% to 5% interest rates. And that's a big deal.
So to briefly summarize, I think you both agree that core inflation has been sticky, and that, people chart a year over year headline inflation number. It looks like inflation has collapsed, but number one, that's year over year. So you have base effects. And number two, it is heavily weighted the price of oil, which is by far the most volatile component of inflation. So if core inflation, which is the underlying forces of inflation, is sticky, the Federal Reserve will be inclined to hike, and maybe hike more, 2, 3, or even, as you said, 4 times. It seems like, Jim, you're accepting of that. But I think the disagreement between you two is you think that, Sam, if the Fed hikes a lot, the long end won't get a bid. Whereas, Jim, you said that the 10-year normally is 150 basis points above the Fed funds.
Yeah. Well, the long end won't get a bid would be higher rates, and stuff. So I think that's really the issue. The issue comes down to the issue we've been grappling with for a year and a half. Where's inflation? Where's inflation going? Where is it now? Are we still in a pre-pandemic regime of when the Fed kept rates at 0 and could not get the inflation rate above 2? Or are we in some kind of post-pandemic economy where they're going to have a hard time getting it anywhere near 2, short of a recession when you have a collapse in demand? And we haven't discussed that, but I'll just throw out that I'm also in the no landing camp. There's the hard landing, there's a soft landing. No landing just means the plane just keeps flying. Yeah. There is no recession. Maybe it loses a little bit of altitude, but it just keeps flying, and there's no recession. That also kind of keeps demand for stuff. If people are continuing to stay employed, 3.5% unemployment, and wealth effect from the stock market gains continue, they're gonna use that money to buy things, and they're gonna bid on things, and your companies are going to be telling you we can keep passing along price increases.
And it's 6.5% Fed funds rate, but for folks at home, it's 5.5% for the top end now. Even that's no landing. That won't slow down the economy.
But that would be something like, I could see one more, just so people understand where I'm coming from. I could see the Fed raising rates one more time this year. Those other rate hikes to get you 6.5, those are 24 rate hikes. So what I'm arguing is this cycle has got more time to it, that it's not going to be September, November, December. It can be, but I don't necessarily think it will be, but that we're just going to keep stretching this out because the federal rate's not raising. They'll hold in September, they might raise in November, but then the year-over-year number on headline inflation is 4. Then there's the big debate. Are we done yet? Maybe not. And then in 24, they might start talking about raising rates again. I know it's an election year, but I don't think that will stop them, at least early on in the cycle.
And to your point, remember the conversation we were having last year was is the recession happening in Q3 or Q4? And what we found was the U.S. consumer just pushed through in an amazing way, right? The U.S. economy was a bull. And I would argue pretty wholeheartedly that it was the U.S. consumer that said, doesn't really feel that bad. Maybe I'll continue to spend. And they have continued to do it. It's really difficult to see what breaks them when they're not stopping at 5.5. Does 6.5 somehow magically stop the U.S. consumer from spending their cash flow? Probably not. And it's, we saw the average hourly earnings up 4.4% year over year, on Friday.
Wages. That's not corporation earnings, right?
Yeah, that's the average consumer. And so you have the average consumer with a 4.5% pay raise year over year. And
Nominal or real?
Nominal.
Okay, so inflation is 3-4%. So
they're spending 100% of their cash flow, and they will continue to do so. And that is a pretty powerful backdrop to the U.S. economy. So it's really tough to stop it.
I know we're running short of time, so let me give you a conclusion for equity investors. What does this mean for equity investors? If you look at the University of Chicago and Ibbotson and Associates, they've done some long-term studies on the stock market. Long-term, many years. It averages about 9% year-over-year gains in the stock market. We were down big last year, we're up big this year, so 9%. We used to use the term TINA, there is no alternative, prior to the pandemic, because prior to the pandemic, we had zero interest rates. So if you wanted to be out of equities, you got nothing or very low interest rate. We're talking about 5.5, maybe 6% in risk-free instruments, 2/3 of the stock market's gain with no risk. There is an alternative. There is an alternative now in a money market fund. There is an alternative in a short-term bond fund. It will give you most of the stock market's gains that you would expect over a long period of time, and it will give it to you with very, very little risk. And that will wind up, I think, being heady competition for the stock market to continue to attract new money as we go forward.
That argument makes a whole lot of sense to me, but as we all know, that stocks have gone up with yields this year.
Right. There's also people that are short-term timers, and the YOLO crowd and stuff. That's a different argument from the I want to put money away for the next 10 or 20 years type of crowd.
Jim, I got two questions, and first one is for you, Jim. How much of the rate hikes do you think the U.S. economy has felt?
I don't think they've felt many at all. We've raised rates over 5%, over 500 basis points. The unemployment rate is lower now than it was when they began. The stock market is only 4 or 5% from its peak. There's been very little pain so far.
But is it coming? Is it baked in? In other words, 550 basis points of hikes, 525, means that pain is coming. It hasn't come yet, but it's coming. Long and variable lags versus what Waller is saying. That means we have to go higher.
I don't necessarily believe in the long and variable lags. I think what the Fed has done is they've kind of moved with the neutral rate higher, and that they're not as restrictive as we think they should be after 500 basis points, which is why I think there's more room for them to raise rates, because they haven't gone way too far just yet. The 5%, fair value for the 10-year note and stuff, they haven't gone way so far that they're going to break something serious. So I don't think we've felt it, because I don't think it's been as painful as we thought.
Yes, and just to add to that, forward guidance is a present problem. Right. When they guided that they were going to continue going, when it was priced into markets, that happened far before it would have happened 20, 25, 30, 35 years ago. And that created a much different dynamic than the long and variable lags.
Yes, but absolutely. But by the way, forward guidance is the name of my show. And but a lot of debt is termed out. So, a lot of people borrowed at a 3% mortgage rate, a lot of high yield corporates. Anyway, last question for you, Sam. Earlier you said something, I'm not going to do it justice, but you said the currency is the start at the bond market. It ends with the bond market, it starts with the dollar. What did you mean?
So what I meant was you always want to watch what's going on in currency markets as the leading indicator of what is going on, both in terms of macro and risk. Right. You never want to ignore what's going on in currencies. So if the US dollar is doing well, that is an indication of, the rest of the world probably isn't doing that great. US economy is doing fine, and vice versa. And there's a lot of ways that you can slice and dice that. And the bond market is the one that teaches everybody a lesson. And it tends to teach people very harsh lessons, and it tends to be very quickly in terms of both what is going on in the world, whether it's that the U.S. economy is doing great, the Fed is raising rates at a pace that is too quickly, too slowly, and whether the Fed funds rate might decline over time, et cetera, et cetera. So I think you really want to pay attention to what's going on in currencies, and you really want to pay attention to what's going on in bonds, because they tend to teach people lessons very, very quickly and very, very painfully.
And what is that pain? That people who are short bonds are going to get smoked when bonds rally when there's a recession, or people who own a lot of bonds are going to get smoked because bond yields go higher? And by the way, that's what happened last year.
So what I would say is it depends on how it unfolds. My tendency is to say that the U.S. economy is going to be pretty good relative to current expectations for the foreseeable future. So if you are, call it long bonds into this cycle, you, particularly on the long end, you might want to reconsider your positioning.
So you prefer stocks over bonds?
I prefer being very short duration bonds and long equities, non-tech.
Interesting. Very well. Well, guys, thanks so much. And thank you everyone for watching.